Ladies and gentlemen, my name is Greg Michalowski for ForexLive.com. This report is for the week starting February 23rd. It's a technical look at the euro versus US dollar. Over the last few weeks, we've been caught in this Greek situation where we've gone back and forth, lots and lots of headlines. Well, on Friday, we had this, 4-month extension, I guess, of the loan agreement. There is still things that Greece needs to do. In particular, send a letter to the EU, the ECB, the IMF, outlining the plans that they're going to take in order to keep their budget surplus or budget in control. And that is going to be released on Monday. Whether or not they accept it, whether or not it's good enough, is certainly up in the air. So they could have some additional volatility as a result of that. In addition, this week, what's most important, I think, if we can get over this Greek hump, is Janet Yellen is going to be speaking on Capitol Hill on Tuesday and Wednesday. Tuesday is going to be most important because Wednesday is basically a repeat of Tuesday. So we'll hear her opinions on the U.S. economy, on the potential for tightening in either June or September. Hopefully she'll give some clues in regard to that, and the market can then react to that. If she's more dovish, that would be more bullish for the euro versus US dollar. If she's more hawkish, then we could see the euro versus US dollar break out of this range. Let's speak about this range and how you can approach it and trade it. Over the last 2 weeks, we pretty much had the identical trading ranges of about 172 pips. This is 1 week. This is the other week right here. And the difference is a pip or two between one and the other. Over that time, we've seen market move to the upside, the downside, the upside, the downside, the upside, the downside, in this wavy type pattern. So again, how do you trade it? Well, what you have to do is you have to lean against the extremes, for one. Number two, you have to like it. You don't want to love the market. If you fall in love with one way or the other, then you're going to get caught when the market reverses itself against the extremes, or has a violent, choppy type of action like we did through here. And so you want to listen to what the market's saying and try to find levels that make sense from a technical standpoint, and look for trade opportunities against technical levels. I always find it easier, especially in choppy markets, to take advantage of certain levels. So what do I mean by that? So let's just focus right here. And you see how the market is finding support against the 100-hour moving average right here. That's an opportunity for you to stick your toe in the water from a long side and take advantage of this move to the upside. Now, in hindsight, we know that the market moved to the upside. What would happen if it moved to the downside? You just get out. If it goes below, if it holds a 100-hour moving average here for a few hours and finding support against that level and then doesn't go higher, then get out. Like it did right through here. We went through the 200-hour moving average here. It should have gone where? To the downside. Did it go to the downside? No, in fact, it pretty much quickly moved back to the upside. The next time the market went down to the 200-hour moving average here, what did the market players do? They bought. They bought the market there. We did ping pong back and forth in between the 100 and 200-hour moving average. Eventually, the market's going to break away from that, and it did. It took a while, like 8 hours here, before the market decided to move to the downside. But the last thing it did was hold the 200-hour moving average right here, and that was a clue for sellers to enter the market. And indeed, the market did move to the downside. Now, it's not as easy as it looks, but what you want to do is don't fall in love with the market. Just fall in like with it. If it doesn't do what you think it should do, or you get tired of it, or you can't stay around anymore, then just get out. Look for another opportunity. There'll be other opportunities. And so in early trading next week, I'm going to be focusing on these three things right here: the 100, the 200, and the 50% retracement. And basically, if it goes below all three, like it goes below the 50% retracement, more bearish bias. If it goes back above the 100-hour moving average, then it's more bullish, and stops around these levels as well. And then look for extremes, look for selling above, look for buyers to the downside, and I think you'll do okay. So there you have it. A look at the euro versus US dollar. Remember, we do have that Janet Yellen, also Mario Draghi speaking on Tuesday and Wednesday. So chance for some fireworks, chance for the market to break out of these ranges. So be aware for that. But in the meantime, just trade the extremes, trade the moving averages and the 50% retracement. I think you'll do okay. Bye-bye now. Good fortune with your trading.